seriously? $65 for like barely over half a tank? Frank, I literally can't with this gas station pump. The numbers just like they kept spinning. I felt like my wallet was actively bleeding.
I know, honey. Well, the pump today is basically a daytime robbery. But the really scary thing is, if we just keep our cash sitting in our joint savings account right now, it's doing the exact same thing, just silently bleeding away to inflation.
Great. So our options are either go broke driving to the grocery store or go broke doing absolutely nothing. Great. What a beautiful, uplifting choice.
Actually, look, there is a third option. It's pretty boring, and it's definitely not a get-rich-quick scheme, but it's literally how we build a cash flow shield for this family. We need to talk about dividend investing.
Wait, dividends? Like the thing where companies just write you a check for existing? Or is there some catch?
No catch, but, well, let's back up for a second. To understand how they actually work, you first have to understand what a share is. When you buy a share, you're buying a tiny piece of an actual real business.
Okay, so I technically own a molecule of Tim Cook's office desk. Got it.
Essentially, yes, but let's use a real example. Remember our friend Ash, the dog breeder?
Oh yeah, the one who realized our city had 0 places to train dogs in the winter, so he wanted to build that massive indoor dog arena?
Exactly. So to raise the money to build it, Ash splits his new company into, I think it was 50,000 shares? Yeah, 50,000. And he priced them at $20 each.
And we actually bought some. We spent, what, $5,000 for, wait, let me do the math, 250 shares?
Right, which gave us a 0.5% stake in his business. Now, Ash opens the arena and bam, it completely takes off. Dog shows booked every weekend, trainers waiting in line, and the value of his business starts climbing.
I remember looking at the numbers. Within 10 years, those $20 shares were worth $50 each.
Exactly. So our $5,000 grew to $12,500. That is the first way you make money in investing. It's capital growth. But Ash also wanted to reward the people who believed in his idea early on. So he decides to pay a dividend, a cash payment to investors based on the company's profits.
So we didn't even have to sell our shares to get that cash?
Nope, you keep the shares and you get paid. Let's say he pays a dividend that works out to 4%. This means for every $20 share we owned, we received 80 cents in dividends each year, usually split up and paid each quarter. And as the business kept growing, he actually increased the dividend. It went from 4% to, say, 6% over 5 years.
So our shares were worth way more, and our quarterly dividend income grew too? Okay, now I see why people love this.
Exactly. It's the double engine of dividends. You get both the growth and the regular income.
Okay, before we get too deep into the weeds, we should probably introduce ourselves properly.
Right.
Good. I'm Lynn.
And I'm Frank. Welcome to Talk and Wonder. We create easy-to-understand whiteboard animations covering family finance, investing, passive income, and debt management. Our goal is to break down complex financial topics, help you avoid traps, and build wealth together. If you want to secure your future, you are exactly in the right place.
But wait, we have to put a massive warning label on this first. Frank makes this sound like a magical money tree. But look, seriously, investing involves actual risk. There is no guarantee Ash's dog arena won't go out of business or that the stock market won't crash tomorrow. You must do your own homework. Do not just throw your grocery money into this blindly.
Oh, absolutely. No free lunches here. You have to understand the risks, which is why, we're going to show you exactly how to research and vet these things safely.
Good, because if we lose our gas money on a bad investment, Frank, you're walking to work.
Understood.
But wait, if dividend stocks are so great, why don't people just buy the highest paying ones? If some random company is paying a 15% or 20% dividend, shouldn't we just dump all our money in there?
Oh, God, that is the single biggest trap in the entire investing world. It's what we call the dividend yield trap. And look, it's honestly the absolute easiest way for beginners to lose their shirts.
Wait, lose our shirts? But if a company pays 16%, that means on, I don't know, 10 grand, you get $1,600 a year. How on earth is that a trap?
Okay, let's look at a real example. There's this real estate investment trust. Actually, let me search it up on Yahoo Finance real quick. Yeah, Two Harbors Investment. Ticker symbol is just the letter T and then WO, 2.
And what's their yield?
Right now, it's sitting around 16%. Sounds like a jackpot, right?
16%? Frank, stop. Wait, are you serious right now? Why are we not putting all of our money into this?
Because if you dig just a little bit deeper, which, let's be honest, most people never bother to do, you'll see that since this company launched back in, 2009, their share price has actually dropped by about 80%.
80%? Oh my God. So wait, if I put $10,000 in there, my $10,000 is now worth $2,000?
Exactly. You collected some nice shiny dividend checks along the way, sure, but your actual principal got completely eviscerated. They're basically using a massive dividend number just to lure in unsuspecting investors. It's a classic bait and switch.
Okay, I need a second. That is terrifying. It's like a store offering a buy one, get one free deal, but they also pickpocket your wallet while you're checking out.
Actually, that's a shockingly accurate analogy. For beginners, it is just infinitely safer to stick with broad ETFs instead of picking individual stocks. But okay, how do we actually find the good ones? We do some basic research.
Ugh, research. You know my eyes glaze over when you start talking about reading dry corporate tax filings. Is there an easier way? Like, can we just use ChatGPT or something?
Honestly, yes. You can absolutely use Google or ChatGPT or sites like Yahoo Finance, Morningstar, and ETF.com. When I first started out, I literally just went to Google and typed best performing dividend ETFs. That gave me a quick short list, and then I plugged each one into Yahoo Finance to check 3 specific things.
Okay, hit me with the 3 things. Keep it simple, Excel boy.
All right. First is the dividend yield itself. Personally, I like to target a sweet spot between, I'd say, 1.5% and 4%. That's usually where you get a healthy balance of stable income and, actual capital growth potential. Anything higher than 5 or 6%, you need to start being very, very cautious.
Got it. 1.5 to 4%. Safe zone. What's second?
Performance history. You don't just want a fund that paid a good dividend last year. You want to see how the actual fund price has grown over 5, 10 years. If the stock price is constantly sliding down, you run away.
Okay, makes sense. Keep the original pile of cash safe. And the third?
The expense ratio. Basically, the annual fee you pay to the people managing the ETF. Look, you don't want to give away your hard-earned dividends to some Wall Street guys in expensive suits. My rule of thumb is to avoid anything with an expense ratio higher than, let's say, 0.5%. The lower, the better.
All right, that actually doesn't sound too bad. So, yield under 4%, steady stock growth, and ultra-low fees. But Frank, enough with the classroom slides. What are the actual ETFs we should be looking at?
Well, let's look at 3 of my absolute favorites, and honestly, the community's favorites too. We'll break down the exact math, the fees, and, exactly how much money you need to invest to get that $500 a month in dividends. Let's start with the first one, which is SPYD. All right, first up on the list is SPYD. It's actually one of our community's absolute favorites. It basically tracks an index of the 80 highest dividend-paying companies in the S&P 500. We're talking super established, kind of boring household names like CVS and Best Buy.
S&P 500. Okay, so these are huge, rock-solid companies. But wait, didn't they take a massive hit back in 2020 during the pandemic?
Oh, absolutely. In 2020, nearly every major business took a nosedive because of, the lockdowns. And you'll see that sharp dip across almost every single stock chart from that period. It was unavoidable.
Right. That was a wild time. But okay, what about the fee? What's the damage on the expense ratio for this one?
It's actually dirt cheap. SPYD's expense ratio is just 0.07%, 0.07, which means, let me do some quick mental math. If you invest $500 a month, which adds up to $6,000 a year, you only pay $4.20 in fees, literally less than a single Starbucks latte.
Okay, I can live with $4. So what's the actual dividend yield?
Right now, the yield is just over 4%, and the share price usually trades around, I don't know, $42 to $45. So to earn $500 a month in dividends, which is $6,000 a year, you would need to invest around
Wait, how much?
roughly $135,000, or you'd need to own about 3,000 shares.
Frank, stop! $135,000 for $500 a month? Okay, I need a second. That is a mountain of cash.
I know. It sounds completely overwhelming. But look, this is designed to pay you a reliable income year after year, not something you just buy and flip. Since it launched back in 2015, SPYD has grown by about, actually, let me look, 42% overall. If you include reinvested dividends, it averages about 9% a year. If you would put $500 a month into it from day one, your portfolio would be worth $85,000 today, and $18,000 of that is pure cash dividends you collected.
Okay, 18 grand in cold hard cash is pretty decent. What's the second option?
The second is VYM. It's the Vanguard High Dividend Yield ETF. This one gives you exposure to a much broader group of U.S. large-cap companies. Think Walmart, Johnson & Johnson, Home Depot, that kind of stuff.
And Vanguard is famous for being ultra low cost, right?
Exactly. The expense ratio is 0.06%, even lower. And since VYM has been active since, let me think, 2006? Yeah, 2006. It actually survived both the 2008 financial crash and the 2020 pandemic. It's basically a battle-tested tank.
Okay, I like battle tested, but what about the yield?
It's around 2.5%. It's lower than SPYD, but that's because VYM focuses a lot more on capital growth over time. Since inception, the fund price has grown by about 180%, so you get less immediate cash, but your main pile of money gets way bigger.
Got it. So if we wanted that same $500 from VYM with a 2.5% yield, oh boy, do I even want to know the math.
Well, with each share trading at around $140 to $145 right now, you'd need to invest about $240,000, which equates to around 1,700 shares.
$240,000? Okay, my brain is officially melting. Frank, that is literally a down payment on a house. Who has that just lying around under their mattress?
Nobody. And you're not supposed to have it all at once. But wait, let me get to the third one first, because this is the undisputed heavyweight champion of the dividend community, SCHD, the Schwab U.S. Dividend Equity ETF.
All right, sell me on SCHD. Why is everyone on the internet obsessed with this one?
Well, it holds major powerhouses like Coca-Cola, Chevron, Cisco, and actually some names overlap, like Home Depot shows up in both VYM and SCHD. That's because when a company consistently delivers profits, multiple funds want a piece of it. But here is the kicker. Since SCHD launched in 2011, its overall growth is 220%, the highest of the three.
And the management fee?
0.06%, just as low as VYM. But here is the real magic. Its dividend yield is around 3.8%, which is higher than VYM. And over the last 5 years, its dividends have grown by an average of 5.8% per year.
Wait, so even if we do nothing, our paycheck from them increases by almost 6% every year to beat inflation?
Exactly. It outpaces inflation. You can check their payout history on Google. They pay every single quarter, like clockwork. Right now, SCHD trades between $25 and $28 a share.
Wait, 28 bucks? That's actually super cheap. So how much to get our 500?
For $500 a month, $6,000 a year, you'd need to invest roughly $160,000, which works out to be around 6,000 shares.
Okay, so 160,000 is still a massive number, Frank. I love the Coca-Cola and the inflation beating growth, but seriously, how does a normal family with 2 kids, high gas prices, and a mortgage even start to build a mountain like that?
That is, well, it's honestly the most important question because look, nobody just writes a check for 160 grand on day one. You don't build a mountain by dumping a whole peak all at once. You do it grain by grain through what we call dollar cost averaging.
DCA, right. I mean, we literally did this. Remember when we first got married? We had, what, like negative cash flow because of our old student loans?
Oh, God, don't remind me. We were so broke back then, we used to, what was it? We actually split a single $1.50 Costco hot dog for dinner just to save $3.
The hot dog of financial independence. But seriously, we committed to just, I think it was $100 a month back then. We set up an automatic transfer from our checking account to our investment account, and we just completely forgot about it.
Exactly. That is the entire secret. You automate the process so you don't have to make a hard decision every single month. Because if you have to choose between, say, buying a new pair of shoes or investing that $100, well, those shoes are going to win 90% of the time.
Hey, speak for yourself. But yes, automating it completely removes the temptation. But what actually happens to that money? How does the math work when the market is constantly bouncing up and down?
Well, that's the beauty of dollar cost averaging. Let's say you're buying SCHD. Some months the market is up, the price is $28, so your $100 buys fewer shares. But then the market dips and the price drops to $25. Now your same $100 automatically buys more shares.
Oh, so when the market crashes, we're technically buying our favorite companies on sale?
Exactly. You actually cheer for the dips. It completely removes the emotional panic because you're no longer trying to time the market. Whether it goes up, down, or sideways, you just keep buying.
Okay, that actually makes investing feel, I don't know, way less stressful. But where do we actually open this kind of account? Do we just walk into our local bank down the street?
No, absolutely avoid traditional retail banks for investing. They'll eat your returns alive with hidden fees. You want to open an account with a major low-cost online brokerage. Schwab or Fidelity are pretty much the gold standards.
And we set up a Roth IRA, right? You always talk about that account like it's some kind of legal tax-saving cheat code.
Because it literally is. With a Roth IRA, you invest with money you've already paid taxes on. But then, the absolute best part is all your capital growth and, more importantly, all those dividend payouts grow completely tax-free. And when you withdraw them in retirement, you pay zero taxes.
Okay, tax-free is officially my favorite phrase in the English language. So start small. Automate $100 or $500 a month, use a Roth IRA on Schwab or Fidelity, and let DCA do its thing.
Right. And as your income grows, say you get a small raise or you sell some old stuff, you just bump that monthly contribution from 100 to 110, then 150, and so on. For me, seeing those tiny dividend payments hit our account, it becomes kind of a gamified obsession. It literally motivates me to work harder and find side hustles because I know every extra dollar is another permanent brick in our family's financial freedom wall.
It really is addictive. But okay, once those dividend payments actually start rolling into our account, what do we do with them? Do we just let them sit there, or is there a way to make the snowball roll even faster?
Well, you basically have three main paths you can take once those payouts start hitting. The first one is, what do you call it? The Dividend Reinvestment Plan, or DRIP for short.
Drip. Okay, I love the name. Sounds like our money has some serious fashion sense. How does it actually work?
It's actually super simple. It automatically takes whatever dividend cash you earn and instantly reinvests it right back into the exact same ETF. So say you get a $25 payout from VYM, DRIP immediately buys $25 worth of more VYM shares. You don't have to lift a finger.
And that speeds up the compounding snowball, right? Because next quarter, those tiny fractions of shares also start earning their own dividends?
Exactly. It's the ultimate hands-off compounding accelerator. And honestly, if you're just starting out, DRIP is usually my absolute go-to recommendation. In the early stages, your dividend income is going to be pretty small anyway, so it just makes perfect sense to reinvest every single penny to speed up the growth.
Makes total sense. Keep the fire burning. But what about option number 2?
Option 2 is what we call self-reinvestment. This is where you collect the cash from your dividend payouts, but instead of putting it back into the same fund, you use it to buy into another one. Like, say you collect your quarterly payouts from VYM, but you decide to use that cash to buy a NASDAQ 100 ETF, like QQQM instead.
A NASDAQ ETF? So you're basically taking the safe, boring dividend cash we earned and using it to buy more volatile, faster-growing tech stocks?
Exactly. It's a fantastic way to slowly diversify your portfolio or tilt it toward more growth and, well, more volatility without actually having to deposit fresh capital from your salary. You're letting your dividends fund your growth.
Huh, that is actually really clever. And what about the third option, my personal favorite, actually getting paid?
Ah, yes, the cash out method. This is where the payouts go straight into your bank account as a real live monthly income stream. You can use it to pay your utility bills, buy groceries, buy gas.
Or buy that fancy avocado toast you always complain about? Yes.
Sure, if you must. But look, if you cash out too early in the game, you're basically cutting your compounding snowball off at the knees. For our own family portfolio, we actually do a hybrid. We do about half drip and half self-reinvestment because I like having the control to manually reallocate our money into different areas.
But the ultimate plan is to eventually shift to 100% cash out, right? In like, I don't know, 10 or 15 years when we decide to fully step back from our business?
Exactly. That is the ultimate end game, having a dividend portfolio that pays for our daily life so we never ever have to sell our original principal. That is what real financial freedom looks like.
And honestly, that is our biggest hope for everyone watching this. We want you to get to that level of financial security and freedom way faster than we did. No fancy finance degree needed, just pure consistency.
Exactly. The hardest part is literally just getting started, opening that brokerage account, setting up the automatic transfer, and buying that very first share. Once you do that, the momentum takes over.
Yeah, it's like turning on the financial cruise control. If you found this breakdown helpful and want to build your family wealth along with us, please hit that subscribe button. We've got plenty of simple whiteboard guides coming your way to help you navigate this journey.
And we'd actually love to know, which of these 3 ETFs would you start with? SPYD, VYM, or SCHD? Or maybe you have another favorite. Let us know in the comments below. We read and reply to as many as we can.
Exactly. Now, Frank, since we're on the subject of cash flow and passive income, who is paying for the gas on the way home today?
I think it's your turn, actually.
Of course it is. Let's get out of here. See you guys in the next video.